So let's start with some of our most basic theories, right? There are obviously many things we'll talk about in this chapter. We'll start this video talking about the Modigliani and Miller theories. These all revolve around taxation. We'll then later talk about the trade-off theory, something called pecking order, signaling, etc. So we'll look at many examples as we go through the following videos. So here we have Modigliani and Miller's theory with zero taxes. So they proved without taxes that capital structure is irrelevant. This is theoretical, but it laid the groundwork for modern capital structure theory. Similar examples were from a previous video where shareholders can create their own leverage called homemade leverage. So it might be less expensive and more convenient to borrow money and invest in stocks by the shareholder than have the company do it. So here we can see that regardless of what happens, the cash flows are the same. Again, regardless of the amount of debt that's chosen, total cash flows is equal. So with this particular example, since cash flows of a leveraged and unleveraged firm are the same, they should have the same values. As companies change their capital structure, the risk of equity also changes in unison to the opposite changes in debt. So although debt is cheaper, when we move to debt, that creates more risk for equity, increasing the cost of equity. And in this case, it exactly offsets the reduction in costs due to lower debt is offset by the higher cost of equity. So in the end, the weighted average cost of capital does not change. What happens when we add corporate taxes? When taxes are included, debt creates value through what we refer to as a tax shield. So debt creates this tax shield that is a benefit to shareholders. Verizon issued $49 billion in bonds in 2013. That was the largest corporate bond sale in history. They did this to finance its purchase of Vodafone's stake in Verizon Wireless. The interest expense generated significant tax shields, making this debt very attractive. In our formula here, we see that the tax benefit is TD. So the cash flow to levered companies is the cash flow of the unlevered, plus this is the cost or the tax shield itself. So Modigliani and Miller showed that the value of R sub D times T times D here, that equals, again, with their assumptions, the total tax times the amount of debt. So that the total value of a levered company is the value of an unlevered company plus whatever T times the debt rate is. What this creates for us then is a slope. The original Modigliani and Miller theory said the value of a company did not change as you added debt. But now we have this tax benefit. So the Tax Cut Act of 2017 cut the federal tax rate to 21%, reducing the combined federal plus state tax rate from around 40% to about 25%. This significantly reduces the tax shield. So the slope of the graph on the previous slide is historically is much lower since the tax cut has taken effect. It's uncertain how the limits on interest expense deductions will impact the line. It could be assumed, though, that it will reduce the benefit since less will be permitted to be deducted, which would be reducing the tax shield itself. Now, Miller's model showed that personal taxes offset some of the corporate tax benefits of debt. For example, individual investors often prefer equities because taxes on dividends and capital gains are taxed at lower rates than bond and interest income. So this theory takes into account all the possible taxes that could be incurred in financing. The corporation pays taxes, investors pay taxes on both equity and debt investments. So our formula now involves the three tax rates. T sub C is the tax rate of the corporate tax rate. T sub S is the tax rate that shareholders pay on stocks. T sub D is the tax on debt. So one of the issues here is that taxpayers have varying marginal rates. If a very lower income person invests in bonds, they may only pay as little as 10%, while a wealthy person may pay as much as 38%. So this term in brackets here relates to the tax benefit, but the tax benefit is different depending on the tax of the investor that we're talking about. So let's look at the maximum rates. The corporate tax rate, 25%. The tax rate on debt, the maximum value would be 37%. And the maximum tax rate on equities, whether it be dividends or capital gains, is 20%. So here we have in brackets here, we have the formula for the tax shield. It's 1 minus the corporate tax rate multiplied by 1 minus the stock tax rate divided by 1 minus the debt tax rate. So that equals then 1 minus 0.95 times D, or in other words, it says that value rises with debt. Each $1 increase in debt raises firm's value by roughly a nickel. Now again, the tax cut made significant changes in the corporate tax rate. There were not as many benefits to investors in equities on the personal side. So we did see that there is some reduction in the tax benefit to bondholders. Now, if we look at real companies, Apple has about $101.7 billion in debt. At the maximum amounts here, debt provides roughly a nickel for every 101.7 billion in debt. That means that their debt financing creates roughly $5.085 billion in value. Now, at the low tax scale, if personal taxes were 10%, then the tax shield would be 0.25. Or for Apple, 0.25 times 101.7 billion, the value of this tax shield then would be 25.425 billion. So the impact of debt on the value of Apple, somewhere between 5 billion and 25 billion. Pretty big range, I will admit, but it is interesting to see how changes in the tax code ultimately have influence on the value of the company and could possibly influence how managers and shareholders look at financing. See you in the next video.